Chapter 11. Financial Market. Question 4. Distinguish between. 4 marks each. 1. Primary market and secondary market. 1. Meaning. Primary market is the market where companies sell their industrial securities, like shares, debentures, etc., for the first time, to raise fresh capital. The secondary market is a type of market where the securities that are already listed on the stock exchange are bought and sold. 2. Mode of investment. In primary market, securities are acquired directly from the company. In secondary market, securities are bought from other investors. 3. Parties in action. The parties dealing in primary market are company and investors. The parties dealing in secondary market are only investors. 4. Intermediary. Underwriters act as intermediaries in the primary market. Share or security brokers act as intermediaries in the secondary market. 5. Price of security. In the primary market, the price of security is fixed, as it is decided by the company. In the secondary market, the price of security is determined by market forces, that is, demand and supply conditions. 2. Money market and capital market. 1. Meaning. Money market is that part of financial market in which short-term borrowing and lending take place. Capital market is that part of financial market in which long-term borrowing and lending take place. 2. Time period. Money market instruments have maturity period varying from 1 day to 1 year. Capital market instruments have maturity period of more than 1 year. 3. Instruments. Instruments traded in the money market are certificate of deposits, repurchase agreements, commercial paper, treasury bills, etc. Instruments traded in the capital market are shares, stocks, debentures, bonds, government securities, etc. 4. Purpose of borrowing. The purpose of borrowing in money market is to meet working capital requirements or for small investments. The purpose of borrowing in capital market is to raise long-term funds, to establish new business, expand or diversify business, or for purchase of fixed assets. 5. Institutions. Participants in the money market are RBI, commercial banks, non-banking financial institution, etc. Participants in the capital market are stock exchanges, commercial banks, financial intermediaries, non-banking financial institutions, etc. 6. Role in economy. Money market increases liquidity of funds in the economy. Capital market facilitates mobilization of savings in the economy. 7. Risk. Money market instruments have maturity period of up to 1 year, and hence, the risk factor is very less. Capital market instruments have longer maturity period, and hence, the risk is more, as compared to money market. 8. Return on investment. Return on investment in money market instruments is less, as they are highly liquid and safe. Return on investment in capital market instruments is comparatively high, as there is more risk involved.